October 7th, 2024. I'm back now. Like I mentioned, I was away at a wedding, so I had a pretty hectic past couple days. But anyways, pretty interesting day today. The really big takeaway that you should have from today, I think, is about the moving average. We started off basically trying to get above the moving average, and if you look, how many closes did we get above the moving average today? One, two, three, four, five, six, seven. So there's 81 bars in a day, and we got seven closes above the moving average. And you don't have to wait until the end of the day to use that stat when it's bar 30, 31, 32. You can see we've only had five or six closes above the moving average in 30 bars. So what do you think is going to happen for the remainder of the day? So I think something that's really important to keep in mind is that when that's happening, it's better not to buy because there's going to be limit order bears selling the market as we get to the moving average. They'll be selling the market here, selling the market here, selling the market here, basically betting that we're not going to get above the moving average. And if we do start to break strongly above the moving average, those bears could become trapped, and it's possible we get a measure move up. However, it's much better to wait to see if those bears become trapped than it is to look to continuously buy minor reversals because that is probably going to become a losing strategy. Bar one, a bear bar, you can see we had a gap down. So there's going to be support from yesterday's higher lows here, probably here, 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 if we get here, here, if we get here. So in general, there's going to be support in this area. You can see we've been in a trading range for the past couple of days. It started up here and it ended down here. So top of the range, bottom of the range. You can see we basically made our way back down to the bottom of the range today. When you get a gap into the middle of the prior day's range, it increases the chances that you're going to get some sort of inside day. And we got a doji bar on bar one after a gap into the middle of the prior day's range, which increased the odds that today would be an inside day. It was not an inside day today, so it doesn't obviously have to be an inside day, but that will just increase the chances that that could happen. So bar one, a doji bar after a gap down, trading range open. Probably buyers not too far below, probably sellers not too far above. After the gap down, the bears are looking at bar one as follow through. So they're expecting that there's going to be sellers above bar one and they'll be able to make at least a scalp. The bulls are hoping the gap down is a bear trap, but then why is bar one a bear close? Sellers above one during two. So bad high one for the bulls. Sellers above. Bears, better to sell above bar one than it is to sell above bar five. You want to sell the first reversal and the second reversal, maybe bar three. But with every reversal, the odds of a leg up in the trading range increase. So by the time you get a third reversal up, bar whatever, five, you don't really want to be selling. You probably want to be looking more to be flat. So bar one, probably sellers, not too far above. Bad high one for the bears, for the bulls, and for the bears. So sellers above, buyers below two, most likely. Bears are hoping low two, bar two is a low one short, but it's really not going to work because it's a bull bar. And quite frankly, after the gap down being the spike, you probably need a deeper pullback before you're going to get any sort of bear channel. Bar three, you can see buyers below two. We're probably going to bounce up into the upper third of bar two. So the bulls who buy below two are scaling in lower, trying to exit in the upper third of bar two. And you can see they pretty much just exited directly above bar three. So trading range open. The bears, they sold above one, they scalped out, they made money. They sold above three, they scalped out during four, they made money. The bulls, they bought below two, they scalped out during four, they made money. So limit order traders are making money, and stop order traders are not making money. So limit order open, limit order market. Bar five, you can see buyers below four during bar five. We have a possible wedge, potentially 3-4-5 or 2-3-4-5. It's definitely a trend line, but probably buyers, like I said, at the new low, the bar one low. So every time we get a new low, you're probably expecting buyers at this point in the day. And every time we get a new high, you're probably expecting sellers at this point in the day. Six, you can see sellers above five. However, a bit of a tricky trade to sell above five, considering the fact that we have three reversals up. So selling above five is not all that ideal. There's probably buyers not too far below six if we do go below six. It's really not worth shorting six because you're selling the bottom of a trading range and your risk is relatively large. So it's not really that great of an idea. But it's also not that great to buy below a bear bar closing somewhat near its low, even if it is a doji. So while there is probably more buyers below six, it's probably better to just be flat. Seven, you can see a bull bar. So the bears who sold above five, say they sold one ticker above five, 81.25. they were able to make about 5 points on the close of bar 6. And instead of holding, taking a chance that the low probability swing trade works, they end up just scalping out and taking their profits. And that's what causes the big bull bar on bar 7. Do you buy above bar 7? Probably not. It's a big bar, so the risk is reasonably big. You're buying high in today's trading range so far. It's more reasonable early in the day to buy high in the day's range because the daily range should double or triple. The past couple days ranges have been 40 to 50, something along those lines. So you know that there's probably going to be that today is probably going to double or triple, or at least double or triple, probably at least quadruple. So there's no real rush to get in. So if you wanted to take 7, you could do it for a low probability swing trade, but it's a big bar, big risk. 6 is your signal. Really not all that great. Probably buyers below 8. You can see if you bought above 7, you're disappointed. You found sellers at the moving average. Most traders who bought did not want to see sellers at the moving average, and instead you get a doji bar on bar 7. So bulls more interested in buying around a 50% pullback of bar 7 during bar 8 than they were in buying directly above bar 7. However, bar 8, failure at the moving average, yes, but 7 is big enough for a second leg sideways to up. And you know that there's probably going to be buyers below bar 8 scaling in lower. Since it's a doji bar, it's not a very good sell. And 7 is a pretty big bar. So traders who bought here probably have a stop not below here, but probably at least a measure move down. And they're willing to buy below 8. They're willing to add more at a new low of the day, taking a chance that we'll probably get back to the bar 7 high at some point today. So you have to be expecting buyers below 8 if we do get there. 9, a bull bar closing near its high. But what's the problem? Well, the problem is you're buying right on the moving average, and we don't have a clear breakout above the high of the day. So if you're buying here, you're buying in an area of resistance, and there's probably going to be sellers not too far above if we do go above the high. So it's really not all that great to be buying above bar 9 at resistance. You can see 10, good for the bulls, but another tail. What do you notice about 10? Bulls were more interested in buying a 50% pullback of bar 9 instead of buying the high. The same way the bulls were more interested in buying a 50% pullback of bar 7 than they were in buying the high of the 7. So bulls, instead of buying the highs, they're still using limit orders and buying pullbacks and scalping out the high. Limit order pullback, scalp out around the high. So it's still more of a limit order market, even though we're getting bull bars closing near their highs. 11, a bear bar. It's an inside bar and a possible short. It's a low 2 short for the bears. So bulls hoping this is the start of their bull trend and that this is a breakup pullback, and then there's another pullback. But to me, it looks like 2 legs up in a trading range and a low 2 short below 11. I would not sell below 11 strictly because it does not close near its low, and this is a reasonably tight channel up with a couple of good bull closes. So it's not really all that great to be selling below 11. However, it is 2 legs up, and it looks like the bulls are failing at the top of the trading range. 12, follow through for the bears, but it's not really all that great. You have to be expecting there to be buyers below, and there's probably sellers above as well. It's maybe a micro wedge, 10, 11, 12, so possibly you get another leg up on a lower time frame, but it's really not all that. Or sorry, 11, 12, 13. I moved on to bar 13. So I'll just go back to 12. 12 would be a bad high 1 at the top of the trading range. It's possibly a third leg up if 13 goes above 12, since we had the first leg up 7. Second leg up would be 9 and 10, and third leg up would be 13. So it's really not all that great. 14, an inside bar, a bear bar closing near its low. Good for the bears. We're probably going at least a little bit lower, but it's really not all that great to sell below the low 1 short on 14. Bears are hoping that the gap down is going to get a second leg and that we're getting some sort of pullback, maybe a low 1 here, a low 2 short, something like that. A bigger low 2 short or some sort of wedge, 1, 2, 3. And that we're going to get a second leg down from the gap. However, they're not getting really strong bear closes, so the bears need to do more if we're going to get that sort of follow through. 15, another bear bar closing near its low. It's good for the bears. You can see we pulled back to the moving average on bar 15, and traders sold the moving average. And that caused 15 to basically close reasonably strong. Is it good to sell below 15? Probably wouldn't, because you're selling near the moving average. You're looking to sell a smaller bar near the top of the range, and you're looking to buy smaller bars near the bottom of the range right now. You're not necessarily looking to do, sell big bars near the bottom of the range. It's still a trading range open. While the daily range should double, triple, whatever, it is still a trading range open, and you have to keep that in mind. 18, a bear bar closing near its low. 16, a bull bar. It's a high 2 for the bulls. The high 1 is bar 13, but it's a bear micro channel from bar 10. So we have basically a 6-bar bear micro channel. Really not worth, sorry about that, really not worth taking the buy above 16, especially since it couldn't close near its high. 17, consecutive bull bars, but large tail 16, large tail 17. So you know we're probably not going all that much higher. And again, we're failing at the moving average, which is really, pretty critical. Bulls, if we're going to end up getting a bull breakout, they need to get above the moving average. 18 is a head and shoulders top, left shoulder, head, right shoulder. And it's also a lower high major trend reversal, you could argue. I think you could argue that the gap down is the spike, and then we have a trend line break from bar 7 to bar 10, and then you have a lower high 18 major trend reversal. It is a small bar, so if you sell it, you probably put a stop above 10, and that's kind of a Walmart trade, I would imagine. You just take it and you walk away for a little while, and you wait till you either get stopped out or you have some sort of partial profit target. You wait till that gets filled in order to do anything. 19, it's follow through, but the tail on the bottom, a little bit disappointing, and a possible third leg down. 1, pull back, 2, pull back, 3. So 18, 19 is a possible third leg down trading range, which is something you have to keep in mind. The bears who sold below 18 were able to make a quick 5 points. And so once they did that, a lot of those traders scalped at least part. A lot of times, when you get a major trend reversal like this, usually it's only a 40% chance of a breakout below the low, which would be the bar 5 low in this case, and a measured move down. So a lot of traders look to scalp a piece at, whatever the minimum scalp size is. And I think 5 points is a pretty credible amount to scalp in this particular context, considering the daily range is only 13 to 14 points. So I'd imagine it might even be 15. I'm just out of curiosity. I'm going to check the exact daily range at that point. Okay, 14.75, close enough. So 5 points is going to be a reasonable scalp below 18. So a lot of traders will take part off during 19. And then you get 20, a bull bar closing near its high. It's a wedge, 12, 15, 20, and a possible head and shoulders, left shoulder 1, head 5, right shoulder 20. So do you buy above 20, truncate the wedge? I don't know. I mean, you maybe can. It's a swing trade for sure, though. You're taking a chance we get a breakout to the upside and some sort of measured move up. 21, good for the bulls. We have consecutive bull bars, and 21 closes strongly above the moving average. So that is an increased chance that we're going to get some sort of measured move up. However, the bulls need more follow through. We're still within a trading range. So can you buy above 20? Yeah, or 21? Yeah, but you're buying still high in a trading range. So not really as ideal as it could be. Usually during a trading range day, or at least a trading range open, the market will try to break out around bar 30. So it's possible that we're going to get something like that here. 22, more follow through for the bulls, but a large tail on the bottom and a tail on the top. It's 3 straight bull bars, 20, 21, 22. So we might end up getting at least a small second leg up. However, the momentum is waning, so it's really not as great as it could be. It's not really all that great by the close, 22, considering the fact that while 21 was a good bull bar, we pretty much just slowed way down on bar 22 and didn't go that much higher. If you were buying the close of 21, you were hoping for good follow through and you really didn't get it. 23, more follow through for the bulls, 20, 21, 22, 23. So we have 4 straight bull bars, but look at bar 23, it's a doji bar. So we have decreasing body size, 22, 23, and increasing tail size. Tells me that this might be a bit more of a trading range than any sort of bull trend. Buyers below 23 during 24, so you have to be expecting at least a second leg sideways to up. 24, the doji bar. You have to imagine that there's probably going to be sellers not too far above. It's a high 1, so it's really not all that good, but 23 was not a good low 1 short for the bears. So buyers below 23, expecting a second leg up. 25, an inside bar. It's a high 1 for the bulls. You buy above 25? No, you don't want to buy a high 1 at the top of a trading range. That, if anything, is an area to sell. We are getting closes above the moving average, so it's possible that we pull back and then get a reversal up, but I think the bulls need to do more. And then you get bar 26, a bear bar closing near its low. It's possibly a bigger head and shoulders top, 2, 10, and 20, 26. So it's a pattern that took 26 bars to form. So it might take its time going to the downside. Also, we have a trading range open, basically 3 doji bars, 1, 2, and 4, and 6. So we have 4 of the initial 6 bars are doji bars. We have a tight range. So two things. One, that the market is probably going to move. If we go down, it's going to move in a way that's probably difficult to stay in and keeps trying to trap you out since we're getting all this trading range behavior. You also know the daily range is probably still going to double because it's so small. 27, follow through for the bears who sold below 26. And you'll notice we have a pattern here where we have a tight trading range and four tops that have the same top. So 23, 24, 26, 27 all have the exact same high. That's called a ledge pattern. And ledge patterns have an 80% chance of going above the ledge and then back down below the ledge. A ledge top, at least, has an 80% chance of going above the ledge and then back down below the ledge within the next 100 bars. So you got to be thinking that sometime potentially tomorrow, maybe in the Globex session, but we're going to rally, back up into this area because I think this is a really strong magnet. We got another ledge over here, which you can see we rallied above and then went back below, but it's still going to be a magnet. So I think this area will be a magnet tomorrow. And if we get up here, this area will be a magnet as well tomorrow. 28, disappointing follow through. So 27, so much overlap. 23, 24, 25, and 27 are all doji bars. So I think if you sold below 26, you put a stop above 10 and you just let the market stop you out if it's going to do that. But 28, an inside bar, a low one short for the bears. But the problem with it is it's a bull bar. Most traders do not want to sell below a bull bar. So you can see we get buyers below 27 during 28. And then a doji bar on 29. Probably sellers not too far above 29. Probably buyers not too far below. But we've got 5 doji bars in the past 7 bars. So we are starting to go a little bit more sideways. 30, a bear bar. But probably, is it sell to close? Probably not quite. It's possibly a second leg sideways down. Again, keep in mind when you have a trading range day, the market usually tries to break out around bar 30. 31, follow through for the bears. So consecutive bear bars, 30, 31. Increased chance that we get at least a small second leg sideways down. We do have a bear micro channel since bar 26. So good for the bears. It's a 5-6 bar bear micro channel. So we're probably going lower. 32, another bear bar, increasing body size, but increasing tail size as well. It looks like a possible parabolic wedge, 30, 31, 32 on a lower time frame. And then we get a big reversal up, 33, a bull bar closing near its high. It's a possible wedge, maybe 10, 20, 33, 1, 5, 33, something like that. Bear trend days and bear channel days form a bunch of wedges, but they usually end up being pretty meaningless. What's the issue with buying above 33? Your risk reward. The bar is really big. What are the odds we get up here before we get down here? No, I don't know if they're 60% with how many bars we've had closing below the moving average today. We've only had 5 or 6 bars close above the moving average so far today, and we're on bar 33. So really not all that great to be buying, even though, I think the quote unquote context looks good. Buying, it seems kind of low in a trading range, and it's a pretty big reversal up on 33, enough that we'll probably get a little bit of follow through, but we've been stalling at the moving average all day, and your risk is really big. So it's not as good as it could be to be buying above 33. 34, follow through, but a tail on the top, really not all that great. If we get to the move, we're getting to the moving average here, so this is going to be the big question as to where we go. Granted, I wouldn't buy above 33, but if we get a little bit of a rally above the moving average and then a pullback and then a couple of bull bars closing near their highs, that would be a more credible looking buy. And you could take that for a swing. 35, another bull bar, but look at this follow through, right? If you bought above 33, 34, big tail, 35, inside bar, but really not all that great, high 1. So I don't think that it's really all that great to be long here. I'd probably rather wait. 36, another inside bar, a bear bar closing near its low, but probably buyers not too far below, scaling in lower. We should get back to at least the bar 32 close, and we might have to try and test down to around the bar 33 low. 37, consecutive bear bars, 36, 37, but after 3 straight bull bars, 33, 34, 35, you have to expect at least a second leg sideways to up. 38, an inside bar, a bear bar, but do you want to sell below 38? I probably would not. It is a doji bar, yes, but it's hard to look to take that short when you're in an area where you don't necessarily want to be buying, but we do keep getting reversals up. Not that they're working, again, we don't close above the moving average, but it's hard to be holding short when we have this. 39, it's 4 straight bear bars. Theoretically, you could sell the close and put a stop above the prior high, higher or lower high. You can see we are getting lower lows and lower highs so far today. 40, a bull bar, but a tail on the top and a tail on the bottom. It's really not all that great. I think, bulls are hoping that it's a midday reversal and that this is just a deep pullback from 33 since the risk reward wasn't that good on bar 33. However, you have to keep in mind, it's not able to close on its high and you're following 4 bear bar 36 through 40. We weren't even able to get it above the moving average on 33, 34, 35. So that's really not all that bullish. 41, an inside bar, a bear bar, but not really worth shorting. Looks just like a second leg down from 36 through 39. We tested the 39 low, so the bears who sold below 39, hoping it would collapse, able to get out around break even on 41. 42, another doji bar. It's another ledge, 39, 40, 41, 42. So increased chance that we go at least a little bit above 42 and then come back down below it. The question becomes, are we going to get above the moving average? The moving average has been a big deterrent all day. So the bulls are really trying to get the market above it, and the bears are trying to continue to sell the moving average and force the market to stay below it. 43, a bull bar, but you can see, where are we again? We're right at the moving average. So we'll see if we end up finding sellers here or buyers. And you can see disappointing 44, not able to close near its low. So probably a buyer's not too far below if we go below. But how many more times are the bulls going to try before they end up giving up? 46, a bull bar, but not a very strong close. And it's not able to close above the moving average. It's possibly 3 pushes up. 40, 42, 43, and then 40, 46, or 45, 46. It's still a lower high from 35, so we're getting consistent lower highs. So not really all that great. Bulls end up giving up, and bears sell the market at the moving average, and that causes 47. A bear bar, but a tail on the top, or a tail on the bottom. So not really worth shorting. It was a potential wedge, 46, but hard to sell a bull bar. 48, a bear bar closing near its low. You can take this for a swing sell, 47, 48, since we've had so many closes below the moving average. And if we get, if 49 is a good looking bull bar closing near its high, you can probably just exit. But with this many bear bars closing below the moving average, we've only had a handful of them close above. Not really a great reason to be looking to buy. 49, a bear bar. So follow through for 48. But the issue is you're selling low in a possible trading range, and you're not getting great follow through. So you wanted 49 to collapse a little bit since your risk is reasonably large. However, the fact that we still have not really gone above the moving average much today is really important. And we haven't touched it. We haven't gone above it since bar 23. It's now bar 49, closing in on bar 50. So increased chance that we get something disappointing for the bulls. 51, we got sellers above 49. Sorry, 50, we got sellers above 49. Not all that surprising. No one wants to buy. It is a wedge, but we keep forming meaningless wedges, and the bulls keep not getting follow through. 51, another bear bar. So consecutive doji bars, 50, 51. 4 straight bear bars, although we did trade above 49, so it's possible a second leg trap. 52, follow through for the bears, but look where you're selling. You're selling the exact low, and you didn't close below the 33 low, so not quite as good as it could be. 52. You can see buyers below 52 during 53, buyers below the low of the day. 5, 33, 53, a wedge. But do you want to buy above 53? There's a tail. It's really not that good. If it was a smaller bar, it might have had some potential, but after 5 straight bear bars, it's really not all that great. And all these close below the moving average. 54 consecutive bull bars, yeah, but looks like the bears who sold the close of 52, disappoint 53, are just buying back their shorts, and that's what's causing the bull bar closing near its high. We're also, in an area where, again, we're right at the moving average, and we haven't been above it in 26 bars. So if you're a bear here, you probably wait to see if 55 is another good-looking bull bar closing near its high. And if it is, then you get out. But there's not really a reason to exit above 54, unless you can get one. The bulls can get one more good-looking bull bar in 55. And sure enough, they don't. 56 or 55 is a disappointing outside down bar. You get another bull trap at the moving average, which is relatively common on bear channel days. An inside bar, 56. So probably buyers not too far below, probably sellers not too far above. But 55 is a big enough surprise that it should at least get a second leg sideways down. 57, a bull bar, but a big tail. We tried to get back to the bar 54 low to let the bulls who bought below 54, which it's not an unreasonable thing to do. And they were looking to scale in. We're trying to get them back out of the trade. And you can see they weren't able to get out on 57, which is really important. It increases the chances that the bulls are going to get trapped. 58, buyers below 57 initially, but probably not too willing to scale in unless we're able to get back to the bar 54 low. 59, consecutive bear bars, 58, 59, probably sellers above 59. And then 60, a bear bar closing near its low. It's a low one short. After the bear surprise, 55, you could sell for a second leg down since you have trap bulls with the 54 low. It's kind of hard to sell 60, I think. But 55 is your breakout, and you're hoping that we're going to get some sort of bear surprise. And 61, a big bear bar. But, it's probably a sell to close bar. Hard to sell below it. But you could sell the close of 61, taking a chance we've reset the market cycle, and we're going to get some sort of measured move down based on the height of the spike. Maybe somewhere down here, down here, down here. 62, follow through for the bears. So sometimes 61 will be a bear trap and you get a huge bull bar 62 trapping the bears in. Instead, you get a follow through bar. It's not the best follow through bar, but it is a follow through bar. So probably sellers above 62. The bulls are hoping that we have a bull trap on 60, but probably sellers above 60, or sorry, bull trap on 61 with 62, but 62 is a bear bar. So sellers above 63, a bear bar closing near its low. Some traders will sell below for a swing, but nothing to buy, right? Probably stop above 63 is fine. There's no reason we're going above 63 without, if we're going to continue down. So if your stop is higher than that, you probably got to be quick to get out. 64, another big bear bar. So a lot of the bears start taking profits. This consecutive sell climax is 55, 60, 63, or sorry, 61 and 64. Let me just write some stuff down actually. So consecutive sell climax is down here, 65, an inside bar, but a bull bar. So probably buyers not too far below, scaling in lower. 66, buyers below 65, and then 67, a bull bar. Bears can probably exit above here, considering we have consecutive sell climaxes and should get 2 legs sideways up. You can see, you could argue this is 1 pullback 2, but it's probably 1 pullback 2. So that was more of your second leg up. We have wedges 1, 2, 3, 1, 2, 3. Would I buy above 67? I don't know. Some traders might, but I would not. I'd probably just let it go and probably just be done for the day if you're short above 67, because realistically, there's no reason to buy. Probably better to just wait for tomorrow, and that's probably the end of the selling as well. For stop orders today, probably, I don't know if seven's not really great, but probably theoretically okay for a low of the day. 18, if you have a stop above 10, you could sell below. You could buy the close of 21, I think, but you have to get up below 26. Bears could sell 26, but the issue is you're selling the bottom of a 5-bar tight trading range from bar 22 through bar 26. So if you're selling here, it's really not as good as it could be. And then hard to do much else. You could sell below 48 for a swing or 49.50. You could sell, theoretically, I suppose, the close of 60. I'd probably wait. And you could sell the close of 61. And that would probably be it for me. The easiest limit order trade is probably selling above 1 or selling above 3. Those probably both made sense. Probably buyers below 8. Probably sellers of the moving average over here, sellers of the moving average over here, probably sellers above 52, but a little bit more difficult in here because of the reversal up here and a second reversal up. Probably sellers above 62. And the daily chart, a good looking bear bar, but I don't know. What does this say to you? Does this scream, we're about to get a collapse, or probably if we go down, it'll just close, maybe a gap or two, and it's just going to become a leg in a trading range? I think it's just a leg in a trading range. This 2 big legs up, probably just going to be a leg in a trading range. We might get 2 legs down. You have to keep in mind, if we got 2 legs up over the course of, wherever it ends, you could argue here, 40 bars, you might end up getting 2 legs down over the course of 20 to 40 bars. If we do go down, this is obviously going to be support this higher low. The weekly chart, we have 4 straight bull closes. So you imagine there's buyers below scaling in lower. So not as likely that we get a giant bear surprise this week. Obviously, the risk is getting pretty large, and we have 2 legs up, and the bulls, are not getting great follow through here. But selling here, while we might get a little bit of a downside breakout, it's probably not going to be all that great. Again, I don't think we're done with 5,000. Not that we're going there this year. We're not. Maybe next year, but whenever there's a correction, the real correction, it's going to come back down to this area, I would think. The monthly chart, you can see, I do think we're going to trigger above this high this month, but bulls bought the 50% pullback of August, so they might look to buy the 50% pullback of September as well. So don't be surprised if we ventured down to the 5,600 area, 5,610, before we ended up finding buyers. All right, that's going to be it for the day.